Thank you so much to the organizers for including this paper on the program. This paper is on search and negotiation with biased beliefs in consumer credit markets, and it's joint work with Erik Berwart at the Comisión para el Mercado Financiero, which is Chile's financial regulator, with Sheisha Kulkarni at UVA and Santiago Truffa at Universidad de los Andes. And the motivation for the paper is that there is a lot of within-borrower price dispersion in consumer credit markets. So if the same consumer goes to many different banks, they'll get many different interest rate offers. And many consumers end up paying substantial costs by borrowing at higher rates than they could because they don't search or negotiate in this environment with a large within-borrower price dispersion. Now, that price dispersion can persist in equilibrium if some consumers do not search or negotiate much. So then the natural question is, why do consumers not search or negotiate more? Existing studies mostly focus on the costs that prevent search or negotiation. And in this study, we're going to instead focus on the expected benefits. And in particular, we're going to ask whether biased beliefs about the interest rate distribution that an individual faces across banks constrain search and negotiation. So to fix ideas, I'll come back later with a more formal model, but just to fix ideas on this question, given this within-borrower price dispersion, why don't people search or negotiate more? Let's think about a borrower who is searching for loans across banks. They have one loan offer in hand at a 30% annual interest rate. Now, this is around the interest rates for these unsecured consumer loans in Chile that I'm going to be talking about. So they have two choices. They can either accept the offer, they get some known value of that offer, and they know what that offer's interest rate is, or they can search at another bank. They don't know what interest rate offer the additional bank is going to offer them, but they have some beliefs about the distribution of interest rates. And so they're going to have some expected value from getting another draw, but they're going to pay some search cost in order to go to that additional bank and get another draw from the distribution. Now, there's a third possibility, which I haven't talked about yet, and that is absent in many of the sequential search models in consumer credit markets, which is that you may also be able to negotiate with the bank. If you negotiate with the bank, you're getting potentially a lower interest rate offer after the negotiation. You may pay some cost of negotiation, but for many consumers, that may be substantially lower than the cost of going out and searching at another bank. So when consumers are making this trade-off between the benefits and costs of search or negotiation, the literature has a lot to say on the costs side. So on the cost of search, there could be high physical search costs across branches. Search costs can also be high due to high rejection rates, leading less creditworthy borrowers to have to search across more banks because they are getting rejected, so they have to search more to even get an offer. There's also cognitive effort required to compare complex offers, particularly because many financial products are cognitively costly to understand and may include shrouded or hidden costs. On negotiating, there's been research, both theoretical and empirical, on the fixed costs of negotiating. And in particular, there may be the cost of gathering additional quotes to use in the negotiation. On the benefits side, most papers, due to data limitations, have assumed that consumers have correct beliefs about the interest rate distribution that they face. In this paper, we're first going to show that individuals have biased beliefs about the interest rate distribution that they face, and then we're going to test the effects of a price comparison tool that we designed to correct those biased beliefs. So the research question that we're asking in this paper is, how do biased beliefs about the distribution of interest rates affect search, negotiation, and loan terms in consumer credit markets? We're going to address that, we conducted a randomized controlled trial with about 112,000 Chileans looking for loans. We first measure their beliefs about the interest rate distribution that they face in a baseline survey, and we then are going to show treated individuals a price comparison tool designed to correct those biased beliefs. We built this tool in collaboration with Chile's financial regulator using administrative data on the universe of consumer loans merged with borrower characteristics at the time of loan application. And what we show in the tool is the conditional distribution of interest rates obtained by similar borrowers for similar loans over the past 6 months. And then we're going to measure outcomes in both administrative data and follow-up phone surveys, where in the phone surveys we collect rich data on search histories and negotiation that we can't observe in the administrative data on originated loans. So the key results of the paper, first a descriptive result. People have biased beliefs about interest rates, and in particular about 3/4 of our participants underestimate the interest rate that they will obtain. They're overly optimistic and think that interest rates are lower than they actually are, and 75% underestimate dispersion in the interest rates that different banks would offer them. The price comparison tool led people to update their beliefs. So it led them to update their belief about the rate they will actually obtain on the loan they take out by about 16 percentage points or 55%. Remember, this is a context where interest rates are pretty high. It also led them to increase their beliefs about dispersion by about 68%. Then we look at what are the real effects of these updates in beliefs, and we find that the price comparison tool had no effect on search or negotiation. It had no effect on search, but it increased negotiation. So in particular, there was no change in the number of institutions searched or formal applications that were made, since we asked both about more informal soft search as well as applications. But it did lead people to be 39% more likely to negotiate, to receive 13% more offers despite not applying at more institutions, to get 11% lower interest rates, that's in relative terms, and then to be 5% more likely to take out a loan. So let me now talk about the experimental setting and design, then I'll walk you through a model to think about what types of results should we be looking for in the experiment, and then I'll show you the results. So on the experimental setting, these are consumer loans in Chile. These are typically unsecured installment loans that are most commonly used to pay down higher interest debt, to purchase or repair a car, to invest in their business, make home improvements, or purchase consumer durables. The mean and median interest rate are about 26% and 24% annual rates, respectively. The median loan amount is a little under $5,000 US. You can benchmark this against the average income in our sample of about $12,000 per year, so these are relatively large loans relative to the income in Chile, and the median maturity is about 3 years. So we started the experiment by serving ads on Google to people who were searching keywords related to consumer loans. So if someone typed, "I want a loan," into Google, or any keywords related to consumer loans, if they were based in Chile, they may have received one of our ads. We served about 4.1 million ads. Then we need, of course, people to click on the ad to participate in the study. About 600,000 people, or 15%, clicked on those ads. Now, before we started the experiment and before we started piloting these Google ads, we were very worried that no one was going to click on these ads. In fact, my co-author Sheisha said the only person she had ever seen click on a Google ad was her husband. But it turned out that a sufficient fraction of people do click on these ads. Then, once they click on the ad, we take them to a landing page of the financial regulator, and they needed to provide informed consent to participate and also to provide us with their national ID number, which fortunately for us is very common to give out in Chile. If you're at the grocery store checkout, they'll ask you what your national ID number is, and that's how they track their rewards programs. I dropped my phone in Chile when I was there setting up this project and cracked the screen, so I took it to a mall kiosk, and at the mall kiosk they asked me what my national ID number was. Now, I didn't have one, but that just goes to show you that these numbers are commonly asked for in Chile, and it doesn't carry the same type of risk as giving out your social security number in the US would. And then we also asked them for their contact information in order to conduct the follow-up surveys. So of course, not everyone continues on when we ask them to consent and provide this information. About 18% of those who clicked continued on in the survey. That's going to be our sample of 112,000. And that's the sample that we have for the first thing that we randomized, which is whether we elicited their beliefs. Now, why did we randomize whether we elicited their beliefs? Well, we thought that merely asking people questions about the interest rate distribution that they face might lead them to introspect more and might in itself have a treatment effect on their search and negotiation and loan terms. Then, after we elicited beliefs, not everyone continues on in the survey, and so we have some attrition there. But we're still internally valid in the sense that now we're going to have this sample of 46,000 who continued on through all of these initial baseline survey questions. And we're not going to randomize them into one of these arms until we see that they actually made it that far. And so this 46,000 is going to be our sample for the main part of the experiment, where we randomize whether people see the price comparison tool, which I'll show you in a couple slides, whether they see a simple tool, which I'll also show you, or whether they see a control video, which was designed to take about the same amount of time as using the tool, but not to have any information that would be useful for search or negotiation. So our first treatment arm was the price comparison tool. We built this using administrative data on the universe of consumer loans in Chile, merged with borrower characteristics at the time of loan application. This is data from about 1.8 million loans to 1.2 million borrowers over 2 years, which is a large sample in a country with the population of Chile. And then we updated it every month to include data for the previous 6 months because we wanted to always be showing people relevant and not stale information. Now, there's a trade-off for how long we show them. If we only showed them 1 month, we would have fewer data points to show you, but it would be more accurate information. We did a bunch of analysis before launching the experiment and landed on 6 months as the right optimum on that trade-off. What the tool shows is the distribution of interest rates conditional on the following inputs: the neighborhood of the borrower, the income of the borrower. Note there are no continuous credit scores in Chile, unlike in the US and many other countries, just default flags. So we're not conditioning here on continuous credit scores. And then we also condition on loan characteristics, the type of loan, loan amount, and loan maturity. Here's what the tool looked like. Normally I would show you an animation of it, but we don't have the right PDF viewer here on this computer. But you can see in this screenshot that we've pre-populated in the top panel the information they already gave us in the baseline survey. But then they can change that information as well, and that'll change the histogram that they're seeing here in the middle panel. We also did a lot of piloting in order to understand, to help improve the tool and make it more understandable. And in those pilots and focus groups, we found that one thing that helps is if you scroll over one of these bars, it gives you kind of an economic interpretation of what the data are showing you. What % of loans to people like you for loans like this got this particular interest rate. And then the last thing that we have is these 2 triangles on the x-axis, where if you drag those triangles, it'll change which 2 interest rates you're comparing in this third panel. And so the third panel shows you for 2 given interest rates, what is your monthly loan cost for the maturity you asked for, and what is your total loan cost. And the motivation of that panel was research that people have trouble converting annual interest rates into loan amounts. Now, we also had a simple tool, where for the simple tool, we thought maybe the first tool is information overload. In the simple tool, we just run simulations on that same conditional distribution we would have been showing you and estimate from those simulations what's the expected benefit of searching at X additional banks. And then they can change, and then they just see that number, what's the savings that we estimate they'll get, and they can change how many additional banks they search. So before getting into the results, let me now walk you through a model that will help us think about fix ideas on what type of results should we be expecting and testing from the experiment. So we're going to start with a standard sequential search model where consumers search for loans sequentially from a continuum of banks, and there's a distribution of interest rates that an individual consumer I could receive from different banks. So we're going to call that H of HI. Utility is going to be quasi-linear in interest rates, and then the consumer is going to have a search cost S. Then when a consumer I meets bank J, the bank can lend at some funding cost Cij. We're going to then add biased beliefs to this standard sequential search model, where we're going to consider that there's a continuum of types defined by theta, where theta, for simplicity, we don't need this for all of the model predictions, but for simplicity, we're going to say that it is how biased you are about the first moment of the interest rate distribution and how biased you are about the second moment of the interest rate distribution. That defines your type. And then, so we're going to put a hat on H in order to denote their beliefs about the distribution. Then we add negotiation into the standard sequential search model. And we model negotiation as a 2-stage bargaining game, where the bank is initially going to offer an interest rate R1 without knowing the consumer's belief type. So R1 can be conditional on the consumer's other observable characteristics, such as their income and where they live, but it's not going to be conditional on their beliefs. Then the consumer can initiate a negotiation, and in the negotiation, the bank is going to observe the beliefs of the consumer. So the intuition behind this is that suppose the bank offers you a 30% rate, how you respond in the negotiation, if you say, oh, how about 5%? Can you do 5%? Versus if you say, oh, I know other banks could offer me 20%, those are going to lead the bank to infer 2 very different things about your beliefs about the interest rate distribution. The bank is then going to offer a second round rate, R2, which can be less than or equal to R1. And if it's strictly less than R1, so if the bank is indeed engaging in this negotiation and lowering the rate for you, they're going to incur a fixed cost D, which you could think of as, for example, additional paperwork to generate that new offer. So with a rate R in hand, a consumer is going to search again if and only if the marginal cost of searching is less than the marginal benefit. So you can think of this rate as post-negotiation. They're going to decide to search again if that cost is less than the benefit, where they can always go back and still take the interest rate offer they have in hand. So we're integrating up to the rate they have in hand. And then if they get a lower interest rate offer, they're just going to gain from that additional, from that reduction in interest rates, since utility is quasi-linear in interest rates. But it's going to be based on their beliefs about the distribution. So then there's going to be an optimal consumer strategy, which is to accept any rate less than a threshold R star, a reservation rate, defined by this formula. So then on the bank side, when deciding whether to offer a lower second round rate, the bank is going to observe the belief type theta and then compare their cost of lowering the rate D, that fixed cost of coming back with a lower second round offer, to the increased demand that they expect to get from the lower offer. So think about this as a reduction in the probability the consumer walks away. There's going to be this residual demand curve that's going to depend on the on the reservation rates for consumers of type theta. So now the bank knows what type you are, but they still don't know your reservation rate, because the reservation rate is a function of both beliefs and the search cost of the individual, which remains private information. So then the bank is going to lower the rate to this R2 star, which maximizes their profits, which are going to be based on the markup that they're charging over their funding cost times this demand, the quantity they're able to sell. But they're going to lower it to that rate if and only if that's lower than the first round rate they offered, and if the profits from lowering it to that rate, the expected profits from lowering it to that rate minus the fixed cost they have to incur to lower it, exceed the profits they expect from sticking with the rate that they already offered. So let me now move into the model predictions. So we're going to make an additional assumption, which is that our treatment, showing them that price comparison tool that I showed you, partially corrects biased beliefs. So the consumer had some beliefs before. They're going to update somewhat towards the truth, not fully. So they're going to change their beliefs from theta to some scaled down theta, some scaled down lambda theta for theta between 0 and 1. In a model, so the first prediction is if we ignore negotiation, which most of the literature on search and consumer credit markets does, in a model without negotiation, a consumer's equilibrium search result is going to be completely characterized by the consumer's reservation rate. So in other words, the reservation rate is a sufficient statistic for the number of institutions searched and the interest rate that the individual obtains. So then, in particular, if the consumer underestimates the first moment of the distribution, as I already told you most consumers do, the treatment is going to increase their reservation rate, because now it's making them less optimistic about what their outside option is. That's going to lead to a reduction in search and an increase in the interest rate they obtain. If they underestimate the second moment, as I also told you most consumers in our sample do, treatment's going to reduce their reservation rate because they're going to update about dispersion. That's going to mean they have a higher probability of getting a lower interest rate offer. That's going to reduce their reservation rate, which will increase their search and reduce their rate obtained. What happens when we then add negotiation into this model? Well, when we add negotiation into the model, a consumer's equilibrium search result is no longer completely characterized by the consumer's reservation rate. Now, correcting beliefs no longer necessarily affects search, because the reservation rate is no longer a sufficient statistic for search. And the intuition behind this is that now your reservation rate also affects your negotiation. So you don't necessarily need to go and search more in order to get that lower rate once your reservation rate is lower. Then we have two predictions that we'll take to the data around heterogeneous effects we expect from the tool based on how biased your beliefs are about the first and second moment of the distribution. The first is that if a consumer is biased about the first moment, the treatment effect is going to depend non-monotonically on the direction and magnitude of the bias. And in particular, there's going to be two areas where if the consumer substantially underestimates interest rates, then the treatment is going to have no effect on negotiation or the rate obtained. So the idea here is that if you, for some extreme underestimation, even after they partially update, they're still going to have such downward bias beliefs about the interest rate that the bank is going to, when they observe their beliefs, they're going to determine, well, I most likely cannot profitably lend to this consumer anyway. Most likely they're going to walk away even if I lower the interest rate to my funding cost. And so therefore, I'm not going to incur the fixed cost to engage in the negotiation and lower the rate. Then on the other end, people who overestimate the rate, the bank also will not engage in the negotiation with those consumers because it's going to think that they most likely will accept the first round rate, even if I don't engage and lower the rate. But then for some intermediate range, so think of this as people who somewhat underestimate interest rates, the treatment is going to increase the probability of a successful negotiation and decrease the rate obtained. And the intuition here is that we're pulling them closer to the truth and pulling them to be more likely in that region where the bank can profitably lend to the consumer, whereas some of them were previously in the region, if we hadn't updated their beliefs, where the bank would not be able to profitably lend to that consumer, and the consumer would most likely walk away. So the bank won't engage in the negotiation. On the second moment, if a consumer expects a lower variance than the actual distribution, then treatment is going to increase the probability of a successful negotiation and decrease the rate obtained. And the idea here is that as they're updating about dispersion, the reservation rate's going down, and that is going to help them in the negotiation. So let me now jump into the results. So first, just a descriptive result based on our measurement of consumers' beliefs, we find that consumers tend to underestimate the rate they will obtain. So here what we're comparing is in the baseline survey, we ask them what rate they expect to obtain on the loan that they actually take out. And so then we can compare in the administrative data, once they actually take out a loan, after participating in our experiment, what rate did they get on that loan. And so here I'm showing you to the left of 0 is going to be people who underestimate interest rates. To the right of 0, people who overestimate interest rates. So for example, a value of -20 could be someone who thought that they would obtain a 10% annual interest rate, but ended up obtaining a 30% annual interest rate. And you can see here that about 3/4 of consumers underestimate rates, some by quite a lot, but there's also substantial heterogeneity here, which we're going to use with that model prediction that I told you. On the second moment, we can't actually compare to what the consumer obtains in administrative data because the thought experiment here of what we're measuring in the baseline survey is if they were to go out and get offers from every bank, what does the distribution of interest rates look like? For simplicity here, I'm just going to use, copying some of the macroeconomics expectations literature, the range between the maximum rate they thought a bank would offer them and the minimum rate they thought a bank could offer them. And the reason for that is that this, in our piloting, was much simpler to ask about, but we have some robustness to other measures that actually try to pick up some of the full distribution as well. So I'm going to compare what they told us their beliefs were about that to what we observe in administrative data from their corresponding conditional distribution. And here you again see that most consumers underestimate interest rates. About 3/4 of consumers are going to underestimate dispersion, but again with substantial variance, and we're going to use this heterogeneity again to test the model predictions. Moving to the effects of the tool, first I'm just showing you how much the tool shifted beliefs. So here I'm going to regress their posterior belief about the rate they would obtain or other measures, subtracting off their prior belief. So we ask them the questions again immediately after seeing the tool or the control video. That's what we measure as posteriors. And so what you can see here is that the simple tool, which merely told people how much they could expect to save, did not shift beliefs in any meaningful way about the interest rates that they would obtain. The price comparison tool, on the other hand, substantially shifted people's beliefs. These are in percentage points of annual interest rates. So this substantially shifted their beliefs about the rates that they would obtain. As I told you before, they were underestimating the rate that they would obtain, so now they're adjusting upwards. And they were also underestimating dispersion, and now they're adjusting upwards their estimate of how much dispersion there is in the market. So now moving to the real effects of the tool. Starting with the simple tool, we observe no real effects on search, negotiation, or loan terms, which is not surprising given that I just showed you that the simple tool did not shift people's beliefs about the interest rate distribution that they face. Moving to the price comparison tool, we see no effect on search, measured either as the number of institutions at which they searched for information, nor the number of formal applications that they submitted. That's consistent with this prediction from the model that beliefs are, or the reservation rate is no longer a sufficient statistic for search, so we no longer necessarily expect an effect on search. We do see that people get more offers and that they're more likely to negotiate. Now, in our initial survey, we didn't ask about the timing of offers, but then we went back and conducted follow-up WhatsApp surveys to test a hypothesis of why we were seeing this increase in the number of offers. And it turns out that a fair amount of the negotiation happens after you apply to the bank, but before they issue you a formal offer. And so these same predicted effects on negotiation that I told you also affect why you would receive an offer. Only if the negotiation is successful and you and the bank agree on a term do they actually come issue the formal offer. We then see a decrease in the interest rates that people obtain and an increase in the probability they take out a loan. This is all in survey data. When we move to the administrative data, we again see an increase in the probability of taking out a loan, but conditional on those who obtained a loan in the administrative data, we don't see an effect on interest rates. So what explains this discrepancy between the effect on interest rates in administrative data and survey data? We spent a lot of time digging into this to understand what was happening. One thing to notice is that because we affected the probability of taking out a loan, that means that there's a treatment effect, there's a selection effect caused by our treatment. In the treatment arm, we're getting additional compliers who would only take out a loan if they see the price comparison tool and wouldn't take out a loan if they were in the control arm. Now, if those compliers are kind of marginal, less creditworthy borrowers receiving higher interest rate offers, then that would pull this treatment effect towards zero, and we see two pieces of evidence consistent with that being what's happening. So the first, we're going to use machine learning to predict whether people are in this group of compliers. So we're going to predict the most likely compliers and the most likely always takers, meaning they would take out a loan either way. And then I'm showing you that same regression where I compare the decile of most likely compliers to the decile of most likely always takers. And here you can see that we are doing a good job predicting compliers and always takers, because if we get the always takers, there should be no effect on the probability of taking out a loan. They take out a loan regardless of whether they're treated, so we get the zero effect there. And then we should get a high treatment effect on the probability of taking out a loan for the compliers, which is what we see here. So that's just validation that this exercise is picking up something about probability of being a complier. Then when we look at these two groups in the administrative data, we see that the interest rate taken for the always takers, for them we do see a negative treatment effect, statistically significant only at the 10% level, but it's not so far in magnitude from what we were seeing in the survey data. And then for the differential treatment effect for the compliers is positive, and the difference between the two is statistically significant. The second piece of evidence on this is that we can also vary over how long of a time window are we looking at loans that are taken out. So in the results I showed you before, we consider any loan taken out within 1 year of participating in the RCT. So here we're going to the administrative data again and changing that time window and saying, okay, what if we only look at loans taken very shortly after participating, within 1 day of participating? So think of these as people who probably already had a loan offer in hand. For that group, we see that there's no treatment effect on the probability of taking out a loan, which means there's no selection effect anymore in this regression. And so if this hypothesis is what explains it, we should expect for them to see a negative treatment effect on interest rates, because these are the always takers. And indeed, that's what we see. Once we start expanding out that window, you can see that we start getting this selection effect in our regression on interest rates, since we can only include you in the interest rate regression if you obtained a loan. And indeed, that's when the treatment effect starts getting pulled towards zero. So now, in my last minute and a half, let me tell you the results from the two predictions from the model. The first prediction was that the treatment effect of the tool is non-monotonic in bias about the first moment, and in particular, that there would be this region of people who vastly underestimate interest rates, and for them there should be no effect on negotiation. That's what we see here. For people who substantially overestimate rates, we should see no effect on negotiation, and then there should be a region in the middle where we see a positive treatment effect on negotiation for those people who somewhat underestimate interest rates. Then moving to the prediction about the second moment, this prediction was that for those who underestimate dispersion, the tool should increase their probability of negotiating. So now I'm going to split the sample into those who underestimate dispersion and those who do not, which could be those who had accurate beliefs about dispersion, overestimated dispersion, or told us, I don't know, in response to those questions, which was a substantial fraction of people. And you can see that the treatment effect on the probability of negotiating is concentrated among those who underestimated the dispersion. We don't see a treatment effect among others. The last result, I told you we also randomized whether we elicited beliefs. That led people, merely asking questions about beliefs, led people to search more and obtain lower interest rates through searching more. In this case, we don't have a selection effect in the regression, and we see a consistent negative treatment effect on interest rates, though smaller in magnitude, in the admin data. So to conclude, we find that people have biased beliefs about the interest rates banks will offer them, both about the level of rates and dispersion. We find negotiation is an important action in consumer credit markets, in addition to search, which is what most of the literature has focused on. But it's very hard for individuals to obtain accurate information about interest rates. I didn't show you these results today, but we do a test to see whether if people went to bank websites, if they search on Google, whether they'll get accurate interest rates, and those are often downward biased and very noisy. And so this means that there's a role for a financial regulator to require that banks report the information to them, as the Chilean financial regulator does, and then to provide it to consumers, as we do in this experiment. Thank you.